Most traders fail, not because the market is unfair, not because the strategy doesn't work, but because of a silent habit inside the mind that decides the trade long before the finger touches the mouse. Studies in trading psychology show that a large majority of retail traders understand their rules clearly, entries, exits, risk, yet still break them under pressure. Again and again. That's not ignorance. That's not bad education. That's an invisible mental process running automatically. If you want to change how you trade, not just what you trade, subscribe now and turn on the bell, because what follows isn't taught where indicators are sold. Imagine your brain like an algorithm that evolved to survive danger, not manage probability. It scans for threats. It avoids pain. It seeks relief. In trading, that algorithm runs constantly in the background, even when you believe you're calm. Mark Douglas once said traders don't fail because of the market. They fail because they can't think in probabilities. That single insight explains why two traders can take the same setup, with the same rules, and end with completely different outcomes. This habit doesn't feel dramatic. It doesn't announce itself loudly. It feels like common sense. It shows up as just being careful, as trusting your instinct, as protecting profits. And because it feels reasonable, you don't resist it. You follow it. That's how it becomes powerful. Have you ever noticed how some trades start perfectly, then slowly unravel because of one small decision you can't fully explain later? You didn't panic. You didn't rage trade. You simply adjusted, exited early, entered late, sized slightly bigger, moved the stop just this once. Nothing extreme, yet the result changed completely. Most retail traders repeat this behavior unconsciously, not because they're careless, but because the brain is designed to reduce discomfort, not protect expectancy. The market creates uncertainty. Uncertainty triggers stress. Stress activates survival wiring. And survival wiring doesn't calculate risk to reward. It looks for escape. That's why losses feel heavier than wins feel good. That's why a small pullback can feel like danger. That's why the urge to do something appears even when the plan says wait. Your mind is trying to help, just not in the way trading requires. Professional traders understand something most beginners never fully accept. Consistency is not about confidence. It's about neutrality. And neutrality doesn't come from believing in yourself. It comes from structure that limits interference. When structure is weak, emotion fills the gap. When emotion takes over, rules become optional. Think about your last losing streak. Not the trades themselves, but your behavior around them. Did you watch charts longer than usual? Check positions more often? Feel urgency too. Recover? That wasn't bad discipline. That was autopilot activating under perceived threat. AI systems reveal something uncomfortable when traders analyze their own data. Mistakes are not evenly distributed. They cluster. After losses, after wins, during fatigue, during overconfidence. The brain follows patterns. And once pressure rises, behavior becomes predictable. A trader can know exactly where the stop belongs and still move it. A trader can plan an exit and still override it. Not because they forgot the rules, but because the decision was made emotionally before logic had a chance to speak. The click was only confirmation. This is why blaming strategy never fixes the problem. The same setup works beautifully on paper and fails in live execution. The difference isn't the market. It's the moment where the mind steps in quietly and takes control without permission. Here's the truth most traders avoid looking at. By the time you think you're choosing, the habit has already acted. The trade feels like your decision, but the path was decided earlier by emotion, memory, and fear of discomfort. And unless you learn to see that moment forming, you'll keep fighting the market instead of the mechanism inside you. Because the real question isn't why that trade lost. It's why your mind interfered at all, and what else it's been deciding, without you noticing. When this invisible habit runs your trading, the damage rarely shows up as one big mistake. It shows up as erosion, small leaks in discipline that don't feel dangerous until the account curve tells the truth. You don't blow up, you bleed out. And because nothing dramatic happens, the mind never sounds an alarm. This is why so many traders stay stuck for years. They aren't doing anything obviously wrong. They follow content. They refine setups. They backtest. But the results stay inconsistent. Because the problem isn't strategy selection. It's moment-to-moment decision quality under pressure. When the brain is on autopilot, emotion doesn't explode. It whispers. It suggests. It nudges. Take profit now. Give it a little more room. Just one more trade. Each thought feels reasonable in isolation. Together, they dismantle expectancy. Chasing losses doesn't always look aggressive. Sometimes it looks like switching pairs, or changing time frames, or taking a setup you would normally skip just to feel back in control. Hesitation doesn't always feel like fear. Sometimes it feels like patience. And that's how the habit hides behind intelligence. The human brain is wired to reduce uncertainty as fast as possible. Markets are nothing but uncertainty. So every open position creates tension, even when risk is defined. The mind interprets that tension as a problem that needs solving. And the fastest solution isn't logic, it's action. This is where most traders misunderstand themselves. They think the urge to interfere means something is wrong with the trade. In reality, it means something is happening inside the nervous system. Heart rate increases, attention narrows, time feels distorted, and the brain shifts from analysis mode to survival mode. Without asking permission, AI researchers studying decision fatigue found something fascinating. Under prolonged uncertainty, the brain starts favoring short-term relief over long-term outcomes. Not because it's stupid, but because it's tired. That's why the same trader can execute perfectly in the morning and sabotage themselves later in the day. The market didn't change. The cognitive state did. If this feels uncomfortably familiar, hit like right now and leave a comment telling me which behavior shows up most for you. Exiting early, hesitating, overtrading, or revenge trading. Most traders never name the pattern, and unnamed patterns quietly stay in control. Here's where awareness begins to matter. Not awareness of charts, awareness of state. What you feel before the trade, what you feel during drawdown, what you feel after exit. When traders start tracking emotions alongside results, something surprising happens. The story they tell themselves collapses. They realize they don't sometimes break rules. They break them in the same situations, again and again. After 2 losses, after a big win, when tired, when bored. The behavior isn't random, it's conditioned. This is why journaling trades alone rarely fixes the problem. Price, setup, outcome, that's only half the data. The missing half lives inside the mind: fear, urgency, relief, overconfidence. Once those states are visible, the habit loses its invisibility. And invisibility was its greatest strength. A simple pause can interrupt everything. Not a meditation, not a breathing exercise. Just one question before execution. Is this execution or reaction? That single moment forces the thinking brain back online. It doesn't eliminate emotion, it prevents obedience to it. Advanced traders reinforce this pause with data. AI-assisted trade journals don't argue with feelings. They show patterns. They reveal that winners are cut short after losses, that size increases after confidence spikes, that mistakes cluster in predictable windows. The mind can deny intuition, but it struggles to deny numbers. Here's the uncomfortable phase nobody warns you about. When you first become aware of this habit, performance can feel worse. Not because you're regressing, but because you can now see the urge forming. You feel the impulse rise, you notice the discomfort, and resisting it feels unnatural at first. This is the turning point most traders walk away from. Because awareness without mastery feels frustrating. You know what's happening, but you don't yet trust yourself to stop it consistently. So the temptation appears to go back to autopilot, because at least it feels familiar. But this phase doesn't last forever. Every time you pause and don't act on impulse, the brain rewires slightly. The habit weakens. Control strengthens. And slowly, trading stops feeling like emotional management and starts feeling mechanical again. Yet even here, many traders plateau. They see the habit. They interrupt it sometimes. But under high pressure, large size, drawdowns, external stress, it still breaks through. Which leads to the deeper question most never ask. Why does this habit regain control exactly when it matters most? And what separates traders who permanently break free from those who relapse under pressure? The reason this habit comes back under pressure has nothing to do with intelligence, discipline, or experience. It comes back because willpower was never designed to operate when uncertainty is high. Under stress, the brain conserves energy. It defaults to learned shortcuts. So when size increases, when drawdown deepens, when emotions rise, the mind doesn't ask what's optimal. It asks what feels safest right now. This is why telling yourself to stay disciplined fails exactly when you need it most. Discipline is a conscious effort. Pressure shuts consciousness down. That's why professionals don't rely on self-control. They rely on systems that remove choice at critical moments. They don't trust the mind when it's activated. They design around it. This is where trading changes from a performance problem into a design problem. Instead of asking, how do I stop myself from interfering? The question becomes, how do I make interference harder than execution? That single shift separates amateurs from consistent operators. Structured risk management isn't just about protecting capital. It's about containing emotion. Position size isn't math, it's psychological load. The larger the size, the louder the emotional signal. Professionals size positions so the signal stays quiet, so the mind stays out of the way. Checklists work for the same reason. Not because traders forget rules, but because stress narrows attention. A checklist externalizes memory. It keeps execution mechanical when emotion wants control. Airline pilots don't use checklists because they're inexperienced. They use them because they know pressure changes the brain. AI models don't feel uncertainty. They process probability. They accept variance without narrative. When traders begin thinking the same way, emotional spikes flatten. One trade stops mattering. The outcome loses meaning. Only execution quality remains relevant. This is why professional traders don't ask, was this trade a winner? They ask, was this trade executed correctly? That question rewires identity. From someone trying to be right to someone managing risk. Every micro-action reinforces that identity. Pausing before entry. Confirming size relative to emotional state. Reviewing behavior instead of outcomes. These aren't habits. They are votes for the trader you're becoming. Most traders wait for confidence before changing behavior. That's backwards. Confidence is a side effect of repeated correct execution, not the cause of it. Act like a risk manager long enough, and the mind adapts. At this stage, trading begins to feel quieter, less dramatic, less personal. Losses don't sting the same way. Wins don't inflate ego. And the urge to interfere appears less often, not because it vanished, but because it no longer controls action. This is where many traders get confused. They think something is missing, the excitement, the intensity. But what's actually missing is chaos. And chaos was never an edge. The market doesn't reward effort. It doesn't reward intelligence. It doesn't reward passion. It rewards consistency under uncertainty. And consistency only emerges when the mind stops fighting the process. At some point, every trader faces a quiet moment of truth. You realize the market was never your main opponent. The setup wasn't the problem. Volatility wasn't the enemy. The only thing that ever needed managing was the mind executing the trade. And once you truly see that, you stop trying to predict better. You stop reacting faster. You stop forcing outcomes. You start building systems that protect you from yourself. That's the shift. From emotional participant to conscious risk manager. From reacting to executing. From hoping to operating. You don't need more indicators. You don't need more strategies. You need fewer emotional decisions per trade. And the discipline to let structure do the work. If you've stayed till the end, you already know this isn't surface-level trading advice. It's a mental operating system, one most traders never install. So subscribe if you haven't yet. Like this video. Comment which habit you're eliminating first. And if you're ready to evolve your trading mind, This is your next step.